going to kick off today with having a quick look at the market and the fallout. And I'm not really going to look through a crystal ball as such, but I thought we'd just start off with explaining what makes the industrial minerals market tick. That'll help explain exactly how much the impact has had on the markets, the fallout in the supply chain, and also, sorry, I beg your pardon. I've just had a couple of, okay, excuse me a sec. Okay, and the fallout affecting the end user markets, and then finally some thoughts on where we might be going after all of this. So just quickly, obviously we're talking about non-metallurgical markets here. We're talking about minerals exploited for their non-metallic value, but the main thing is that something that's easily forgotten is that they're actually used in several different markets. One mineral can be used in several different markets. And if you look on the right-hand side there, you'll see pretty much a large list of A to Z of the main markets used that use industrial minerals. And the point I'm trying to make here is that there's lots of different types of minerals used for one market. So in the top 6 market sectors, you can have 30 or more minerals used in these areas. And following that, in the next 6 or 7 market sectors, you can have as much as 20 or more different industrial minerals used in these markets as well. And so obviously many minerals are used in a range of the major markets. And you'll probably already starting to see an idea of why something like a pandemic really affects this market. These minerals are used in so many different manufacturing industries. But also it's not just the mainstream industries, and particularly what's kind of quite glamorous at the moment is looking at the new growth markets with smart devices, new energy sources, of course. And this is obviously pricked the consciousness of governments and a lot of industry bodies as they find that minerals are in short supply for some of these markets. Just over the last sort of 20 years or so, there's been an increasing emergence of the criticality of industrial minerals. And, this has really increased over the last 5 years, where more organizations and bodies have got involved in this. And, so much so that the US government is actually making official calls to action to develop and secure their lists of critical raw materials. So all industrial minerals are obviously economically important, but some have strategic value. But this is all very relative. For example, rare earth minerals are obviously going to be important for high-tech devices, but of course, if you're a beer brewer, then diatomite is your strategic material. But how is the market driven? Obviously, the performance of the end-user market really drives industrial demand. So basically, without a market, there's no mineral demand and there's no mineral demand. There were clearly major trends that shape the market, which are macroeconomic trends, really. And these are the primary demand drivers that shape industrial minerals demand: economy, population, development, geopolitics. The market is also, though, affected by very specific trade factors as well, which affect the trade of minerals, markets, and regions. Some of these may be like resource market proximity, specific market demand trends, limited resource distribution, reliance on imports, China, we'll get to that in a minute, pricing, logistics, and world events. And all these, anything that impacts these particular drivers will affect the industrial minerals market. And the industrial minerals market can be simply explained in 3 major sectors, really, with direction of supply and opposing the direction of demand: supply, logistics, and market. And these can be broken down a little bit more, showing the functions in the supply sector, the logistics sector, and the market sector. And the thing is, each supply chain has its own set of characteristics. And then this may seem a bit of a detailed slide to begin with, and just something I'm sure will remind all of you as we go on, but these presentations will be available afterwards for download. So this is really just showing the supply options for raw material supply. going from the mineral producer, trader, processor, intermediate end user, and then the end user market. And traditionally, there is, the normal route from right through these different stages, but then there are different options where an end user might have its own processing plant, or they might direct buy directly from the mine, or they might even own the mine themselves and their processing unit. And increasingly, we're seeing a new mindset that's involving much more of the cycling of these industrial units. So onto the fallout and the impact on the market. And the supply chain impact, the big thing that everyone realized, and this just isn't in minerals, it's on all kinds of items that were impacted, was the over-reliance on China. Of course, China was affected straight away with the coronavirus, and its logistics and its manufacturing and mining industries were obviously locked down first. And this, of course, was felt very keenly by buyers in the West. And just to give some perspective, China is the world's leading exporter of industrial minerals, some 8%. And these are some of the markets where Chinese industrial minerals are imported to by value. But this has happened before. We had earlier warnings with the SARS epidemic in 2003, the 2008 Beijing Olympics, and more recently from 2017 and ongoing, the clampdown on the anti-pollution drug. What we're seeing really is it's a much deeper and much wider with the pandemic. So just by way of reminder, I suppose, amongst all the many minerals that China supplies, it commands a very strategic importance in fused aluminas, magnesia, graphite, silicon carbide, mica, talc, and rare earths, for example. And here's some of the percentage figures for the share of the market shown in this slide. And also, just to give another kind of perspective, and this is looking at the USA and its net import reliance on industrial minerals. And you'll see these tables flashing up as from 100% to sort of 70 to 90 to 100%, upwards of 40%, and upwards of 20% net import reliance on these industrial minerals just into the US market. And I've highlighted in red and capitals just how much of these are dependent on Chinese sources. In summary, the US net reliance of some 28 industrial minerals, 23%, the US relies on more than 50% of imports. And of those, 16 are from China. So that's quite considerable. So this was felt very keenly, and the Cybersecurity and Infrastructure Security Agency designated amongst the beginnings of the lockdown in the US, central crucial infrastructure sectors. And of these, this is a very big table with details, so please look at this in your leisure. But I just wanted to emphasize the main market sectors where industrial minerals were deemed extremely important. And so there was some resilience in the industrial minerals market. This happened in Europe as well. But in the USA, it seemed to be spelt out a lot clearly. And many of these sectors could retain some degree of activity. It wasn't all plain sailing. For example, while certain container glass manufacturers could keep manufacturing their glass, some of their raw material suppliers could not keep up their operations. Some soda ash producers in Wyoming, for example, had to close their plants as a result. So it was not all plain sailing, but it does give you an idea that with the essentiality, as I'm calling it, of industrial minerals, this really did focus governments' minds that these minerals are very important. And we actually had a little warning of this, and we'll probably talk a little bit about this later with Rick's talk as well, is the effect of the trade war, where the tariffs started coming in 2018. There was some industry lobbying. This is against Chinese trade into the USA. And certain minerals were excluded from the tariffs, refractory minerals and barite, for example, but many others remained on the list, including mineral end products. But of course, as we all know, watching the current press, these tensions are rising again, and there might be more of the same to come. So we're not out of the woods with this one, and we'll have to look very carefully at this. So just quickly on to GDP, which really is the barometer of industrial mineral markets. And you can see, just for comparison, that global financial crisis, the world all-round GDP was down by 0.1%. The advanced economies, of course, took a bigger hit, down to 3.3%, and the emerging economies were sort of surviving a bit better at 2.8%. And this is from the IMF, by the way. And but if you look at the COVID-19, there's a much bigger hit, minus 6.1 for the advanced economies, minus 3 for the overall GDP of the world, minus 1 for the emerging nations. Interestingly, the IMF, if you just look at the down here, the IMF is predicting a rebound of almost 6% in 2021. So I think it's probably too early to see, but this is a good barometer of the way the demand for industrial minerals will go. Just quickly, I'm going to give you 2 examples of markets that have been impacted by COVID and how it's affected mineral supply. And steel, a very important market for industrial minerals, a whole range of different minerals used in refractories, and very few source countries actually provide these minerals. And of course, China is a big supplier of those. And there were 2 waves, really. The first wave, in a way, was in the West. The buyers of refractory minerals from China were suddenly seeing bottlenecks and a squeeze in supply. They couldn't get the materials because China was having its lockdown. Then, as China recovered, and you can see this here with their recovery of steel, just here from the dip started in February, then China kind of recovered. As China recovered and its logistics mineral supply started to recover, actually in the West, down, and we still are in our recession, and very steep dip in steel production here, which immediately reduced demand for all refractory materials in the West. And buyers weren't buying; they were just running down their stocks. So in May, which is the latest figures, there was a sort of almost 9% decrease on the previous year in May. And this is interesting. All the major advanced economies in the West, huge reductions in steel production in May. China's actually already started its recovery. So it's eased the bottleneck from China, the squeeze in China from somewhat, but the demand is not there in the West. As a result, we've seen a reduction of prices for a number of industrial minerals, and these are continuing. Here I've got DBN and fused magnesia, bauxite, and brown fused alumina from refractory windows, and these prices are still continuing to go down somewhat, and you can see the inflection points from sort of February onwards. They're trying to firm up the prices a bit by introducing a dynamite ban. This is running from July right through to the end of the year, and this is actually obviously preventing any new primary ore from being available. I should add that this is only for open pit. But what this means, the next couple of, if everyone could turn off their microphones, that would be fantastic. And what's going to happen probably in the next couple of months, much difference, but probably from September onwards, we're going to see maybe a tightening of supply if there is demand coming back from the West. There's less and less material available. And also we need to think about the winter shutdown that will probably come into play as usual in October in China. Now, if that comes in, there won't be any material produced in China. Just rely on the material that's produced now in October. So you might see at the end of this year some firming. And just quickly on to oil. We're looking at
Mike, could I interrupt you? Could I interrupt you for a minute? Whoever is calling in on the phone right now, somebody's calling in on the phone and you have not muted yourself, and it's disrupting the webinar and not allowing people to hear. So if you're calling in on the phone, could you please check if you are muted, and could everyone please mute? Sorry, Mike, to interrupt, but thank you.
I was just double checking it wasn't my own microphone. Thanks. So just finishing off really on oil field, and there's a whole range of minerals used in this. I'm just it's not letting me carry on. Hold on a sec. There we go. So and kind of an A to Z of a lot of different minerals are used in the Thank you. Someone muted me, so I'm back with you. Okay. So I'm back on. And in the oil field, if we just look at the active rig count, which is obviously a good way of just seeing the general activity. I'm just having some trouble with my PowerPoint at the moment, I'm afraid. There we go. There seems to be a bit of a delay. The red line is the international activity. The blue line is the US activity, and we have the oil price here as well. And you just see it's all starting to drop, particularly around the March time. And this is a huge drop for demand for industrial minerals used in the oil field industry. It really bottomed out in April 20, down 25%, and there's a historical lows from the US WTI oil price to 27. There is some recovery starting here, but it has absolutely decimated the industry. These summary slides from Schlumberger really emphasize the dip in oil supply and demand. And really, when you look at the dip in North American oil rig activity by 60%, 20% internationally, not such a big dip, but that has decimated the minerals industry for oil field. And in particularly the fracking operations, where something like 50 to 55 barrels US dollar per barrel is required to make these economic. It is argued that a lower price can make it, but generally it's been pretty bad. Frac sand producers have gone into bankruptcy. There's some huge names here: Crevier, High Crush, Vista Proppants. And to be fair, a number of frac sand and proppant producers did go into Chapter 11 earlier. 2017 onwards, there's been a bit of a dip in this industry, but it just completely dropped in the last couple of months. And Carbo Ceramics and Superior Silica Sands are now re-emerging out of Chapter 11 with new ownership and having restructured. And I think that's going to be the way forward for a lot of these companies. Elsewhere, of course, barite mines and plants are idle or have very little activity. And QMax Solutions, one of the leading drilling fluid providers, that's now into receivership. And just a few days ago, Jeff Miller, CEO of Halliburton, looks as if he's sort of reminding us that the North American industry is going to be a slow growth recovery, whereas international demand might be a little bit more buoyant and, as he puts it, a more meaningful contributor. And so to the outlook, and just overall, obviously, the impact's going to have a continuing effect on the recession in the West with the GDP and markets, with a very slow recovery for the rest of the year, I think. But I think in Q1, if we get all our ducks in a row and there's no second wave impact, we might have an accelerated impact in the first quarter of next year. I think the main thing that will be focused on by a lot of companies will be revision of supply chain strategies, raw material sourcing, and in particular security. I think we're going to see more policy and drive from governments and regions like the European Commission and the European Union to stimulate resource development and security, and infrastructure projects also to stimulate the economies from COVID recession in any case. And that will be a great boost for industrial minerals now. Also, there's going to be an increase in M&A as companies restructure to survive. And I know Rick in a minute is going to be chatting a bit more about that. And just looking specifically, China, well, I think ongoing uncertainty on the supply quality, prices, and availability. I think there's going to be, we need to acknowledge the increasing domestic demand from China's own markets. And there's going to be increasing opportunity to import, to export to China. Their imports have been growing. I think, we need to think that exports for Chinese mineral producers are actually less of a priority than they used to be. And they'll be, given that the economy there is going to recover well, as it's already seeing signs of doing. China, I think, Chinese mineral producers will be looking to supply their own markets before they export. So I think there's going to be a kind of a decoupling of China by a lot of overseas buyers. India has already made some quite bold statements about this in the steel industry. JSW Steel, for example, have just already announced of a no China buy policy for refractories. And RHI Magnesita, they've opened a mag carbon brick plant in China using materials from outside India and outside China. So this might be the way forward. I think there's going to be obviously increasing Chinese interest in overseas so I've got you guys' screen on me. Excuse me. And then there's going to be opportunities to joint venture with Chinese companies in China and the overseas. An interesting offshoot of the trade war is that some Chinese end users will be setting plants up overseas to import raw materials from China. Puyang Refractories just announced its a new magnesium carbon brick plant in Kentucky. It can't. Can everyone see the presentation, John?
No, the presentation's disappeared. You need to share the screen again, I think, Mike.
You got it now?
Yes, sir.
Okay, great. I don't know what happened there. I had some interference from another screen coming. I think there's going to be increasing opportunities to perhaps JV with Chinese companies. And as I mentioned, Puyang, because they can't export their end products out of China into the USA, they're going to build an end product plant in the USA and then import the raw materials that aren't covered by the trade tariffs. So an interesting way around for them there. So just going on to mineral sourcing strategy, I think overall there's going to be a big stimulus for mineral development of new sources worldwide to lessen this over-reliance on China and other sources that are getting stressed. Particularly obviously as we look at the high-tech, smart and growth industries. Key industrial minerals are going to be some of these like magnesium, bauxite, graphite, fluorspar and rare earths and lithium. And the picture on the right is bulk shipments that just started from the brand new first bauxite mine that's recently opened in Guyana. It's the only high purity refractory deposit developed deposit that is not Chinese owned, and this is just long-term investment from resource capital funds. Vertical integration, we might see more of this already. Refratechnic, a leading refractory producer in the West, has not only JV'd in China to ensure supply of raw material, but also it's bought a major producer in Australia, so keeping its options open in and out of China. And I think there's going to be a big drive for M&A with company restructuring and financing. Just a few days ago, North America's sole rare earth producer went public with a merger with a private equity group, their mission to restore the full rare earth supply to the USA. So I think we're going to see more of that. And then finally, I think the evolution of mineral recycling is really set to accelerate. The main drivers obviously being alternative mineral resources, cutting costs from waste disposal, a move to the economy to protect the environment, of course, and this is the circular economy that the European Commission is so keen on. And recycled raw materials from waste will become the normal supply chain option for mineral buyers in the future. There's still challenges to be met, of course, with pricing, quality, advanced sorting techniques and processing, not least the harmonization of waste handling and permitting between countries, and the general education, I think, of the industry and the ridding of the stigma of recycled material as contaminated. We'll see increasing economic alliances between waste sources, the end users and recyclers, and this will lead to cooperation in modifying end product formulations to ease the end-of-life recyclability. More primary mineral producers are going to be involved in recycling tailings and other waste sources, and maybe introducing blends. And also, this will also give a favorable green label to the miners' portfolio. We're already seeing a lot of it. And finally, there's some excellent examples from LKAB, Norsk Hydro, Rio Tinto, and very recently the Arkema Nutrien joint venture of utilizing the industrial minerals out of their waste. So I think overall there's going to be a lot of these development going forward. And finally, I'd just like to say thanks for your attention. Sorry about the odd interruption, but hope to see some of you at our Board One Day Do meeting, where we'll be looking at the future of the industrial minerals and markets. So thanks very much, and over to you, Rick.
Thanks, Mike. Can you hear me okay?
I can, thank you.
Okay, and is my screen sharing?
It is.
Okay, thanks. And Mike, you get time to mute. All right. Oh, thank you. Just as a caveat here, the two gentlemen speaking before me are the real experts in this industry. My focus has been on corporate finance and M&A, and now my screen is frozen. Okay, there we go. So just briefly, what we'll be talking about is our view of the economy. It's a little more pessimistic. The unique factors to the downturn, and there's going to be implications for M&A in that regards. As Mike said, China's very important, so we'll have some comments on China. And one area that's overlooked is SMEs, small and medium-sized enterprises. In this case, companies in the 20 to a couple $100 million range. And there's opportunities that are often overlooked for those players, which we'll talk about. So in the global economic outlook, we have a fairly pessimistic view, especially on the near term. If you look at it, if you're a half empty or half full glass, actually the glass is full, half of it's filled with water and half of it's filled with air. And a lot of that air may be hot air, depending on who's talking. So hopefully you won't find that to be problematic here. We've been hit with this devastating, synchronous event globally, and all countries were pretty much hit at the same time. And it's moving very fast. We're lucky here in Asia that a lot of the countries got hit early and have been pretty strict with lockdowns. A week or two ago, China, for example, was in the winning section. I'm in Thailand. They've really pretty much conquered this right now for the time being. But this is very quick moving. This chart we actually made 2 days ago, and when we went and updated it this morning, 2 other countries had fallen into the red zone, Canada and Singapore. So we have a fast-moving target, and it's moving in the wrong direction. I think one of the big issues here is the U.S. The Confederation there has no signs of slowing down, and people don't want to wear masks. They don't want lockdowns, and we're heading into flu season. Come September, October, and we don't have enough testing capabilities. As an example, my daughter just got tested for coronavirus. It's been 10 days. She still hasn't gotten the results back. So, and we're pretty dependent on the U.S. a lot of times for the U.S. consumer to drive growth. And that leads us to record unemployment. The IMF estimated globally that the equivalent is likely to be 300 million full-time jobs have been lost globally right now. In the U.S., the unemployment rate has hit a peak, an all-time peak at the last 50 years. It's about 17 million people out of work. That's not including furloughed people. And we're seeing for the first time, an all-time low in terms of the population that's not employed. And to put that into context, you need about 30 million jobs to get that back up to the peak from 2000. The U.S. consumer is driving a lot of the demand and the turnaround, and U.S. consumers, with this type of unemployment, people are going to be afraid and they're not going to spend. We're hit with global trade tensions and political tensions. China and U.S., of course. The U.S. has picked fights with Europe, with Canada, with Mexico. Now the UK and China are having a spat. We've got protests around the world in the US and Hong Kong. These trade and political tensions aren't conducive for a strong recovery, and these issues aren't going away soon either. Interestingly enough, Mike had these projections from the IMF from April. They just recently released new forecasts, and if you look at that, so the column on the left side is the new forecast, and on the right, those are how much it's dropped from the previous April forecast, and that's a pretty significant drop. And they've qualified those as that's dependent on whether lockdowns come back in or not, whether people use social distancing, whether displaced workers can find jobs in new sectors, whether their funding shortfalls can be breached. So again, we've got a moving target, and it's moving in the wrong direction, and it's moving rapidly. There are, however, some unique aspects of the downturn that have an impact on M&A and might argue for a fast recovery or a faster recovery. First of all, stock markets are at all-time highs. This happens to be the S&P. The MSCI Global Index is somewhat similar, and this is, to many people, is mind-boggling. And you know, when they're scratching their head, how can this be? This is being driven primarily by one factor. It's global interest rates. These are also at all-time lows. In some places, bonds are actually negative yield. You're actually paying somebody to hold your cash. And so the reason people are in, have moved into stock markets is that the equities are the only place where you can get some returns, particularly in the dividend-paying companies. There are advantages to the low rates. Companies aren't, this isn't hurting income statements. Companies are not paying huge amounts of interest. Home loans are also equally lower cost. But on the other side of that, a lot of debt has been taken out as a result of this as well. Also, the other thing that's different is the amount of cash that's on the balance sheets of corporates. U.S. corporates hit an all-time high in 2019 with $4 trillion of cash or marketable securities. That cash can be put to use for M&A, share buybacks, investment in plant equipment, dividends, etc. But they are cashed up, and I wouldn't expect them to blow through all of this in the epidemic. Another factor, which is relatively new, is private equity has become a major player in the buyout market, or in the M&A market, and they've hit also. 2019 was a record year for raising money. They have $2.5 trillion of dry powder, money to spend, and they only spend that on investing in businesses, unlike the corporates. And they like to, once they raise that money, they're looking at a 2 to 4 year period to invest that. So they're going to be active buyers in the markets. So what are the implications for M&A? Well, interestingly enough, these downturns offer some excellent opportunities, some obvious and some not so obvious. But first, what we'd like to do is talk about M&A and the business cycle. So what you have here broke this down simply into a peak, recession, and recovery. And the peak, that was 2019. We were seeing record multiples paid for businesses. There was a lot of competition for deals. When you were valuing a business, there was growth assumptions that made sense. You feel you had some visibility. Maybe some savvy buyers were kind of waiting for corrections. That's been expected, having nothing to do with the virus. And then we start with the downturn, and that was really Q1 2020. Early on, people are still trying to finish deals that they've closed. There was some renegotiations. Some of this was in the press. You might have noticed, Advent in terms of their Forest Court acquisition. They did renegotiate that. That came down 15%, but pricing was starting to fall. Then markets freeze, and that's the stage we're at now in Q2. Sellers, they're still thinking about their businesses worth money in the stable markets. Buyers don't know how to price because they want visibility on future business performance. You will see distressed deals; those will happen, but generally M&A activity comes to almost a relative standstill, and we're there now. And ultimately, as the recessions bottom out, you get multiples down from 25 to 50% from peak. That combined with businesses businesses declined has really puts a beating on valuation. Given it takes 2 quarters for growth to turn around in a recession, and where we are on the virus, I don't think we're going to see something until there's a vaccine out in the market. So we're probably looking at 2021, maybe even into 2022. Hope not. But then you get into recover, the deal velocity and values pick up over the recovery, which periods tend to be fairly long for the recovery periods. Just a little evidence here. The 2019 was the peak. These were what we've got on this slide as buyout multiples. Asia peaked at actually 14 times EBITDA. These are leverage buyouts. Also, in terms of we're in the middle of this downturn. M&A deals tanked this second quarter. This has both deal volume and deal value, and they fell to 10-year lows. And we don't see that picking up immediately. People in the industry are trying to be optimistic, but I think we've got another couple quarters where it's going to be tough. Once this happens, I'm sure all of you with your firms have gone through the same process. There's emergency planning sessions that you sit down and, of course, focus on costs, risk mitigation, how to maintain employees and protect the business. And then the next stage, firms will start turning their attention to growth. In slow growth markets, organic growth is going to be very tough. That means you're going to have to steal business from a competitor. And that's much harder than acquiring customers in high growth markets where you don't have to take business away from somebody else. So in this type of environment, most M&A growth is going to be driven by M&A. Most growth is going to be driven by M&A, excuse me. Now, are you a buyer or a seller in this market? Obviously you generally don't, you think you don't want to sell when the market's low, and you don't want to be buying when the market's high. That's the logical thinking, but there's actually interesting opportunities on both sides. Boston Consulting Group last year released a study where they studied over 51,000 deals over 40 years and assessed how they performed in different conditions. And actually, weak economy acquisitions performed much better than strong economy acquisitions. And this is what relative shareholder return. So that's additive returns to shareholders above a base. And that's almost 10% better over 2 years. Quite interesting. The logic on this is that obviously you're buying low and eventually that asset value picks up over time. What's not quite as obvious is selling into downturns, and selling non-core divestitures create value also during downturns. And in this study, after a year, they found that the cumulative returns to investors over the base index was 3%, which isn't too bad. And this suggests that companies who are selling non-core assets in the downturn are using these funds for something that is more beneficial to the business, financing a turnaround, taking advantage of other acquisition opportunities, etc. Now, a quick shift to China, because it's such a major player in the industrial minerals market, and Mike talked about this a bit, we thought it would be important to touch on. There's been a lot of talk of decoupling, and that started actually more than 10 years ago as China wages started to rise, and then you had the floods in Thailand, which impacted supply chains for automobiles and disk drives, for example. And so people have been talking about a China plus one strategy for quite a bit of time. But with all the political tensions and etc., China is still a major player in the industrial mineral sectors, and that's going to remain the case going forward as well. So we expect a very active market, like Mike said, in China. For sellers, you begin looking to diversify for dependency. We also have had a lot of clients who found anybody who's operating there knows China is a difficult market, and this may be the time where you rationalize your business and say that's just a little too tough place for us right now. There will be China buyers in the market, and some buyers foreign investors are going to be counter-cyclical and possibly looking for opportunities. China had been a major investor outside of China, outbound investment over the last 10 years, but due to political tensions, U.S. and European markets aren't going to be where they're putting their money. They're going to be active in Asia. They're keen on the Belt and Road Initiative, and of course, they've been very active in Africa as well. For buyers, China is still the second largest economy and growing market in the world. One of the strategies a lot of people are talking about is China for China. You're in China to serve the China market, and you look for other bases to support exports. For those who've been in China already, it was hard. Usually it's a pretty hard learning experience. And if you've gotten up to speed and you know how to operate in that market, it's hard to throw that expertise away. We expect to see, multiple buying opportunities. A lot of foreign firms are wanting to exit. We're starting to see that. Also to JV where there's mineral rights are involved. Mike mentioned Fracking, who had invested in, did a JV in China and then secured its supply of mines in Australia. And it's a good time because valuations are off peak, as sometimes China valuations were pretty crazy. The last thing we're going to talk about is SME businesses. SMEs tend to be ignored in the M&A world. They're pretty small, and they tend to be kind of bystanders in terms of being, they're just targets, but they're generally not proactive. And what we've seen in the region, there's a generation of owner-operators who are kind of gray-haired like myself, and they sent their kids to medical school, and they don't want to be operating a mine or an extraction operation, and they've been looking for exits. Often these businesses are profitable, but they're low growth and dependent on customer bases. They haven't invested in the technologies, et cetera, that they need to move up value-added curves. A lot of times they have factories that are near cities that have increased hugely in value over 20 or 30 years are worth more than the business. But they don't have the cash experience or risk appetite to pursue acquisitions. This doesn't mean, though, that they can't be a player. These types of companies should be considering non-cash deals. Basically, we're talking about a merger, and this can be either into new markets or in your own market where you're operating. The challenge here is owner-operators have been, are often entrepreneurs used to working for themselves. So put a context where they may not be is often an emotional struggle. But the benefits of this is you don't need any cash. You become a larger company. If you're doing this in the same market, you can reduce price competition. You increase your customer base, and that's really important. A lot of these companies have fairly small customer bases. You have synergies or economies of scale. That's particularly in the admin side of the business. You can broaden the depth of the management team, which is also often a challenge with smaller businesses. And then you can start working on corporate governance. You're presumably going to have shareholder agreements and start, a board reporting setup. And those all have value to a business. Also, some of these assets, property assets or things like that are idle or underutilized could be spun off. And that yields additional returns. And then you could prepare the business for a sale or exit for the next upcycle. So that's, I think we've covered that in under 20 minutes. Just to wrap that up, we're in the worst economy ever. We've got very poor visibility in the short term, and that's going to make deals tough. I think the other factor that's going to make deals tough in the short term, which I forgot to mention, is travel. A lot of the potential clients we talk to are starting to look, doing research for acquisitions, but until they travel, it's hard to really get a deal done. As we have a colleague who says M&A is a contact business, and without being able to contact face to face, that's difficult. We think we're going to be facing low growth markets in the next 1 to 3 years. However, with corporates and PE funds being really cashed up, we think the M&A is likely to rebound ahead of the economy. We would expect to see that by early next year, I think. Especially once a vaccine is announced, even that starts providing a time frame for recovery. The down markets do provide opportunities on both the sell side and the buy side, and there's also opportunities for SMEs who are willing and able to take advantage of them. And that's about it. Thank you. I think I'll turn that back over to John.
Mike and Rick, thank you. You both covered a lot of ground in a very short amount of time. I want to apologize to the listeners for the technical difficulties. and the background noise we had during Mike's presentation. I think that we got that straightened out. We're going to go into a Q&A session. Mike, if you could turn on your video and join us. Prior to doing that, I want to just answer the question that several people asked about, will the presentations be available? Yes, they will. There'll be two ways to receive these. You can reach out to the speakers and they'll send them to you, or Mike will be posting these on his website. Tractus will also be posting them on our website and our LinkedIn connections. So several ways to get the presentations, and if there are specific questions for your business on the industrial mineral side or the M&A side, please feel free to reach out to us. Listening to both presentations, it made me think about a couple of chronological events here that have happened in my career, and the first was, of course, the crisis of 1997. And it's very similar feel right now to 1997. And the economic crisis became a global issue. The industrial minerals industry was impacted severely. I remember at the time I was working in industrial minerals, and we were opening a plant, and our sales dropped 70%. And there was I remember sitting with my staff and saying, well, we have really two options. One, we do nothing and corporate is never going to blame us for it. Or two, we take this brand new plant and the minerals that we process here and we look at other applications for them. And I can probably say that the team chose the latter and did a fantastic job of, within really 3 years, diversifying that plant and what they were doing and the sales to recovery and hitting the goals. So that's really the type of events that I think we can see going forward. The second time is, of course, in 2008 when we had the same sort of crisis on a global basis, and again you saw a downturn. And I think in both of these cases, when the economy turns down, as both Mike and Rick have shown in their slides, that the demand for industrial minerals is going to not only decrease but lag, because consumers are not going to be looking to buy the same type of consumer goods, which is much of the driver of the industrial mineral sector. So we did receive some questions, and I want to thank all of you for that. I'm going to start first just with a question that I have, Mike, for you. Which minerals are in most demand, for new and alternative sources?
Yeah, it's a good one, and one that I'm frequently asked, to be honest. Just quickly, in case you hear a bell in the background, that's the ice cream van that's just decided to pull up outside my house. It hasn't done it in all the time I've been here, so that's about 13 years. So there you go. Yeah, so you can look at it in two ways. That some of the clearly the glamorous new growth markets at the moment, such as smart devices, new generation batteries. That's really fastened on the so-called critical minerals. And as I said before, someone's critical mineral might not be another person's critical mineral. But certainly lithium and graphite have perhaps become the star of attraction for a lot of investors. And I think when you look at some of the stock exchanges in Canada, particularly, you see a lot of people investing in graphite in Africa and Canada, lithium in South America, and also Africa as well, actually. But also, two of the main, another way of looking at it is some of the major minerals that China has traditionally been exporting around the world. That's where people are really looking to look for alternatives. So that'll be barite, fluorspar in particular. And these are also minerals where, even outside China, they're not very well established commercially. So there's very few sources. Barite, for example, after China, it's really India and Morocco, then a bit from Mexico, and that's kind of it. So COVID pandemic aside, and let's just say the oil field industry was ticking along as usual, you know, you've got a couple of million tons of barite coming into the US Gulf. You know, people need alternative sources. Others, of course, for refractories would be certainly aluminosilicates, bauxite, andalusite, and of course, high purity dead burn magnesia. I think overall, what we're finding with a lot of minerals in China is that some of the best quality materials have been mined out, and or perhaps the mining engineering wasn't ideal, so it means that some of the good quality material is unable to be got hold of. So there's been a lessening of quality in China. So actually, you know, people just do want, they're happy to pay for a little bit more to get consistent, good quality materials, and those are some of the minerals I've just mentioned.
Thanks, Mike. Maybe I'll turn one question to Rick. And Rick, a lot of what you talked about at the end there were mergers, which we're likely to see in this case. Mergers are effectively joint ventures. And as an avenue for investment, given that most joint ventures don't succeed, particularly cross-border ones, do you favor that route? And perhaps you can talk about how they can succeed.
Okay, well, the latter part may be difficult. As a general rule, we frown on, you know, joint ventures. John and I have been out in Asia for between, you know, roughly 30 years for both of us. And when we were first out here, most of these markets you couldn't operate at all without a joint venture. So we've seen a lot of cross-cultural joint ventures. Regulations have changed to a large extent, and so if you can go it alone, we generally recommend that pathway. And we recommend joint ventures generally in cases where there's legal requirements. When there are joint ventures, the 50-50 partnerships generally aren't the best routes, where there's definitely one shareholder that has a controlling stake, and also that shareholders agreements build in exit mechanisms. So if there is disagreements, and this is just over time, corporates, you know, tend to go to different strategic directions, and what markets are possible, are important to them. So having good shareholders agreements with an understanding of what happens that goes wrong is a good mechanism to make sure you're in place. Yeah, I think that's being aligned. I think is going into the deal is very important, but it's like a marriage. You know, everybody's excited getting engaged, but the divorce, nobody's planned for the divorce. So plan for a divorce as part of the exercise.
Yeah, so one of the questions we had from the audience touches on politics, and it's asking about the naivety of politicians to the supply chain for industrial minerals. So I would think that is, you know, making the assumption that you know, our politicians, our governments making good decisions in terms of their policies, and do they actually understand the implications that they're making on the industrial mineral sector?
Mike, you're on mute, but I think that's for you.
Nice reminder, thanks, Rick. Yeah, I'll start this one anyway. Yeah, we can't always get inside the heads of our politicians. I think, to be very, very frank, you know, our industry generally, as other mature industries, have been quite slow on the uptake on PR and education of how important the things that they do are important. And I think, you know, as one of the things I was trying to explain in one of my earlier slides on the so-called essentiality of industrial minerals, I think, you know, a lot of politicians and certain governments are actually in ignorance of how important some of these supply chains and minerals are. So I think there is naivety, but a lot of it is just probably from a bit of ignorance and not being actually told by the industry themselves. I mean, I think actually the industry, certainly in Europe, is certainly organizations like IMFORMED Europe that are really trying to get the industrial minerals industry to be very proactive and talk to governments as well as the public about the awareness of it, how important it is and how important it is to keep supply chains going. I mean, Europe trying to open a new mine is virtually impossible at the moment, and yet governments are now saying oh, but we need lithium and rare earths and this, that, and the other. So, I think it's going to be a new process for a lot of governments to suddenly get on track very quickly. If you look at some of the information from Bedrock Minerals talking about the growth of electric vehicle company factories, they're going to start growing in Europe, and those batteries that are going to supply those EV factories are going to require minerals to make the new generation batteries. And there are people prospecting for these minerals in Europe at the moment, but the governments need to get with it. So yes, I think there is naivety, but I think they're going to quickly get focused, as indeed the US government have on. Again, it's been a slow time coming, but we're getting there.
Thanks, Mike. Here's a really interesting question and a very optimistic one. There's a question: if there's a rapid recovery to the economies in the next year, are there enough alternative mineral sources outside of China to satisfy demand in the short term?
I think there are, but one thing everyone has to remember is, sometimes it takes a few years to get an operation up and running. So that's, you don't want to cut corners. And I have to say, in the industrial minerals world compared to the metals world, like a gold mine could be up and running and maybe a lot quicker than a silica sand mine. The short answer is yes, there's enough material, but there has to be the right strategic planning and also an understanding of what you're trying to develop. For example, in lithium, it's not just about the ore in the ground, whether it's going to be a salt brine or a hard rock deposit. It's really the chemical processing and refining of the ore to make it a sellable product to then sell on to the battery producers. That's the kind of key. So people need to know what they're doing. So there's enough raw material, but you need to get the right guys on board to help you get it all the way through.
Thanks, Mike. Rick, you mentioned in your presentation that non-cash deals were going to be something that SMEs get involved in. And maybe you could give a successful example, because I think the industrial minerals sector is going to be an area where that could be particularly attractive and something that companies would be interested in doing.
Yeah, I sit on the board of a company. It's not in industrial minerals, but it's in the architecture and design business, and that was 12, 13 years ago a $3 million company, and we brought in a CEO at the time, and they merged 4 companies together. They were then subsequently able to raise money on top of that. They have then and they're in about 12, 13 countries. And then about 2 years ago, they did a merger acquisition. They were still the majority shareholder of a fairly sizable player in Australia. This year, they acquired somebody in Singapore. And we've got other negotiations going on. And this company grew, to a factor of 10-fold over this period. And these were all share deals. And so it allowed them to expand geographically in a couple markets. Now they're combining within markets to reduce competition. The geographic expansion was quite nice because except for in the case with COVID and in most downturns, it's not so synchronous with every country being hit the same way. So that was quite an advantage of having that diversification. So this was a great example. They're complex deals relative to the size of companies, but it's worked out quite well.
Mike, a question was asked how the Middle East, North Africa region has performed in terms of its procurement of various industrial minerals during the COVID-19 crisis over the last 6 months, and just wondering if you would comment on that.
That's what Middle East,
North Africa.
North Africa buying industrial minerals into North Africa?
Yeah, it says procurement of various industrial minerals imports.
Into the Middle East. No, I don't have too much on that. I mean, my only familiarity would be with the oil field market, where certainly there's ongoing trade like between India and China into the UAE, for example, and from Morocco and Algeria into the Persian Gulf for the oil field industry. Kind of the other way round, if you like, there is a lot more interest in prospecting for new sources in the MENA region, certainly. And I know people have been looking at all kinds of minerals in the Morocco, particularly fluorspar, barite, but also magnetite as well. And there's some interesting clays also in Egypt as well. Again, with industrial minerals, it's a real, industrial mineral buyers are very loath to, or the plant manager who makes the product and uses the industrial mineral are very loath to change to a new supplier, even if the price, it's half price or whatever. So it's all about getting the right grade and having it tested, bulk tested, and that can take up to about a year or so, or even longer. And actually, one of the interesting questions I had with another webinar was, how can the industry, the producer and the buyer, work together to try and concertina down this testing period, so that that people perhaps can switch to new sources a lot quicker, which would be really good. But it's another example of cooperation. So I've not said too much about the MENA region, but I don't know too much about that. John, do you mind if I just jump in? And there's a question I saw about recycled materials. And it's a really good one. It's the age-old question of recycled materials are priced much higher, and the question has said that the basic material, obviously meaning the primary raw material, and will the industry buy the product then? And that has always been, there's been two stigmas in a way about recycled materials. They're too expensive, so why would I bother? I'll just buy the mined material. Or secondly, there's some sort of toxicity or tarnishment with the recycled product. They were valid questions, I think, up to about maybe 5 to 10 years ago. What's happened now is a lot more, become less of an esoteric, expensive industry and much more of a mainstream industry, with major processors investing in very good equipment to do very good sorting and quality control on the recycled product. So I think the quality is not an issue at all now. Now on price, yes, of course, one has to get competitive. But what we found in the last 2 years, when there's been such a squeeze on raw material from China owing to the environmental clampdowns, is that actually buyers now are actually just want to secure the physical material, not at any price, of course, but they're more interested in just maintaining the safe security of a consistent supply of good quality material. And so that sentiment now is kind of helping the recycled products get a much more of a better foothold in the market. So in Europe, I have to say the whole recycling industry is mainly centered in Europe at the moment. But I will say that in South Korea and increasingly in India and China, the recycling industry is certainly growing very quickly. North America, I'm afraid it's not really there, here and there, but really it's in Europe. But I think the recycling industry is going to have its time very soon, if not already.
Thanks, Mike. There are a large number of questions specific to geographies and alternatives to China and specific industrial minerals. And I think as we're already at 70 minutes, what I'm going to ask Mike, and I know you'll like to do, is defer and let you answer those specific market questions as a follow-up with people, because I think we're really at the end of our time. So I think this has been a really excellent discussion. Mike, your detail on what is happening economically, politically to the industrial minerals market in the COVID era, it has been really insightful. And when you see the number of questions that have come in that you're going to have to follow up on, you're going to have a bit of work. And I think the other thing I want to do is I want to encourage people to think about what their strategy is coming out of this. I think both speakers were pessimistic on where the economy is going, and I think that's a reality. The U.S. Economy is not going to come out of this anytime soon based on where it is in its viral curve. If you look at the examples Rick used on some of the countries in Asia or Europe that have come out, they're coming out into a global downturn. So while there's an uptick in markets, you're not going to see the U.S. driving demand. China itself is going to be a healthy domestic market and source for industrial minerals, but also a domestic market for those consumer goods. But we're going to be looking at growth rates in the 2 to 3%, not the 5 or 6%. So when you think about that economic growth, I think there'll be a large number of industrial minerals companies that need to look at how they can grow through M&A, through mergers, through acquisitions. And I think that Rick was spot on when he talked about the opportunities to grow even when you're in a downturn. And so with that, I'm going to do two things. I'm going to make another little advertisement for the next event. So the last event that IMFORMED had was in Mumbai in November. And I'm going to share my screen here so that everyone can see that our events, let's see, I'm not able to do it. There we go. Can you guys see my screen? So, yeah. So what I was going to get this stuff out of the way. What I was going to say is that our events usually aren't quite this boring with the three of us up talking. This was the event in Mumbai with Mike and Ismini doing a little Bollywood dancing here in November. And so come April 12th to 14th in Amsterdam, the IMFORMED Rendezvous, the Vision of Industrial Global Minerals. Let's hope that we're all getting together again and we're having some good Dutch cheese and beer and we're dancing whatever local dances there are. So thank you very much, everyone, for your participation. We will have the presentations available. And Ismini, I saw your chat. Oh, you were a wonderful dancer. And it was a fantastic night. So I encourage you all to join these events in person and get a chance to shake it on stage with Mike and Ismini. Thank you, everyone.
Thanks, everybody.
Thank you, Mike. Thank you, Ivan. So thank you, Rick. It's a wonderful session. We are looking forward for more such events. This is really, really wonderful. Keep it up.
Thank you.
Thank you very much.
Yeah, this was great. Thank you.
Appreciate it.
Yeah, thanks, Mike. Thanks, John. It would be better if you can just share these presentations to all the participants. Thank you.
Thank you. We'll be sharing them online as I said, so everyone will have access to them.